Hello everyone, welcome to our review of the practice problem using American Eagle. Information given in the problem. This is copied directly from that. This is at the end of 2020, and so then we will go ahead and do 2021. And the journal entries are shown here. The transactions were given as a list. So this is our starting point. We have a unrealized gain, I should say, on our debt securities. That is recorded as we learned a couple of chapters ago, or a couple weeks ago, debt securities and accumulated other comprehensive income. It is not an income statement item. It is part of the statement of comprehensive income, other comprehensive income specifically. Now, we're going to also keep track of the outstanding shares because we're going to need to know outstanding shares for our calculations later. All right. So to figure out outstanding shares, we take the number of shares issued, 249,566, and subtract the shares in the treasury. All right. So if you look at that, that is exactly the formula in there. Because I copied the information over from Word, I can't actually reference the numbers. I had to type them in. Okay, but the outstanding shares were 166,993. So we had two purchases of stock. So we're going to do things a little bit out of order. We're going to handle both purchases of treasury stock first, and they really are this simple. The amount spent is a debit, okay, credit cash for both times. What's different is because the price is different of what we paid them, and this is often how companies announce them. They will spend a certain amount. They do not tell usually how many shares they're going to buy. They say we're going to spend X number of dollars. So in this case, this is $100 million. Okay, as we're going to deal with everything in thousands, but it doesn't matter. Whether we have the 3 zeros over here or not. Okay, so this is the shares that we bought given the price that was given in the problem, $16, $62.50, and $55.56. So that's going to, both of those are going to reduce the number of shares outstanding. Now, I'm not keeping a running total. I'm just going to do that. You certainly could, and that would be helpful as well. But when you buy back the treasury stock, okay, that reduces the shares outstanding. Then we move to the reissuance of shares. All right. And we did 10,000 shares, 20,000 shares at $10. All right. So we record the cash, and then we record the cost, what we paid. Now, this was given to us in this problem. We would have to, in real life, if we didn't have that information, we would have to go back and we apply first in, first out. We find that when we bought those shares back in the past, what we paid for them, that's the credit to treasury stock. In this case, it was given as $8, so 20,000 times 8. And then the difference is not a gain, but additional contributed capital, additional paid-in capital, whatever the terminology they use. In this case, they use additional contributed capital, so we will go ahead and use that terminology as well. That's number of shares. There's 20,000 shares involved, and that's going to make our outstanding shares go back up. So the purchase makes them go down. This shares makes it go up. All right, so that's important because at this point, we're going to have a stock split, which is actually accounted for as a stock dividend, which is typically what happens in real life. Okay, 175,000 shares at this time. So we took this, subtract, okay, and add, and we get 175, 187. This is a large stock dividend, and large stock dividends are done at par value, and we go back up to our information. Par value is usually listed on the balance sheet, 1 cent. Okay, so this is the number of shares in thousands. Okay, so we're going to take that number, multiply it by 1 cent, and we're going to get 1,752. We're just going to move the decimal place over 3, round off, and that's how much we're going to record this stock dividend for. Here's the formula calculation. And this is the number I used in the journal entry because I rounded that. You're welcome to keep the fractions or decimals if you want. Okay. Retained earnings, debit, credit common stock. That's no additional paid-in capital, no additional contributed capital when you sell, when you do that at par value with large stock dividend. All right. So that is your large stock dividend. And then you add, so this number of shares basically comes double. Outstanding shares becomes double. Only outstanding shares are going to participate in this, right? In this stock split. So that's why it's important we know what the outstanding shares. It's not the amount of shares issued. It's the amount of shares outstanding that get this stock split or stock dividend. So we now have twice this many, right? When it comes time to pay our dividend, and our dividend is 40 cents, okay, or 0.4 times the 350 million, because there's dropped in 3 zeros on everything, okay, is 375. And then this is the amount for the dividend in cash. Skipping the dividend payable step a little bit, which would make it a little more complicated, but really doesn't add much to our understanding. All right. So that leads us to our statement of changes in stockholders' equity. Again, we have columns for the different areas. Preferred stock is there, but doesn't have anything going on in it, as you saw on the original balance sheet. There's just a dash, which is the same thing as a 0. Okay. Common stock started at $24.96, and then we had one journal entry to that for common stock for $17.52, so we're up to $42.48. Additional contributed capital, there was only one journal entry that affected that. There was the $40,000. It went from $577 to $617. The AOCI, which is part of stockholders' equity, had that unrealized gain. It was already at a loss, okay, accumulated, and so that gain makes that go down, if you will, or up, however you want to describe it. Less loss, more closer to 0. And then retained earnings is changed by the net income, which was given in the problem. We didn't make any journal entry per se for it, okay, but it was included in the problem. With stock split, changed retained earnings, right? There's a debit or reduction in retained earnings. And then our dividends, of course, the most important, well, maybe not the most important, but the one that is clearly important to the stockholders, $141.50. Reducing the retained earnings. Now, I put them as negatives, okay? Sometimes, as long as you are clear about that you're deducting the dividends, you can just use regular numbers. It's up to you, okay? Treasury stock started at negative, and that's going to always be a negative, right? Because we're always subtracting that from our other stockholders' equity. And then when we purchase the treasury stock, we're going to make it more negative. We're going to debit it, okay, more negative. And then when we sell it, okay, for the 160, okay, that's the 160, then that is that's a credit to treasury stock, which actually makes it go less negative, more positive, however you want to think, best, easiest way to think about it. And there's your ending balance. Those ending balances all come here to the balance sheet. So this is the stockholders' equity section of the balance sheet. Looks a lot like this without the fancy shading and everything. Okay, common stock, additional contributed capital, accumulated other comprehensive loss, retained earnings. Okay, treasury stock, the same things. Okay, and notice rather than telling you what the number should be in the little parentheses or explanation, I told you how you would calculate it, right? Okay, so this is, you would add the number of shares in treasury We started at 82,517. It went up by this, up by that, and down by that. Okay, so outstanding shares goes the opposite way of the treasury. How many treasury shares you have, right? Because treasury shares are subtracted. So that is the practice. Okay, that should help you and prepare and get be able to do the homework in good order.